The E-mini opened with a small gap, but most of the time when you have a small gap, it closes within the first hour. You can see that we closed the gap in the first minute, first few seconds. Friday was an exceptionally strong bull trend day. And the context is very good for the bulls on the daily chart. We had a very good signal bar on Thursday, very good entry bar on Friday, but we're still right below some lower highs. We've been forming lower highs since the January high. And we've had lots of good bull days, but we've also had lots of good bear days. We're not getting a series of good bull or bear days. Even here with this big sell-off, it was just 2 big days, and then we had a big bull day. Until the market is able to string together 4, 5, 6 consecutive trend days one way or the other, it's going to remain in the trading range. The bears need to break below major higher lows here, and the bulls need to break above major lower highs here and here. This one is not as major. I think this is more important. As good as the past 2 days have been, the bulls need to do a lot more. I talked about this rally when it was happening, that it was not looking strong, and that increased the chances of it going sideways. If we get a rally here that looks like that, then we probably will continue sideways. If we start to do this, a series of bull trend bars, 5, 6, 7 bull trend bars, then we're probably working our way back up to the January high. Remember, double top bear flags. Double top possible here, double top possible here, maybe even here. Double top bear flags typically come from fairly strong rallies. It looks like the market is reversing up, and then it gets to around the prior high and collapses. And until we break strongly above the prior highs, there's about a 40% chance that we'll get a double top and a collapse. Globex session, sideways the entire session. Sometimes you get a small gap up that closes like this, and you still get a big bull trend day. When you have a very strong trend day like we had on Friday, there's a 50% chance you're going to get follow through buying in the first hour today, first 2 hours today. Usually, once you get it, it can start on the open. The bulls are trying to get it to start right now. Once you get it, it lasts less than an hour or so before it either reverses or enters a trading range. We're right below the close of last year. That's been an important price. Here's the close of last year on the daily chart, and the market's been going above and below it repeatedly. Actually, I have it drawn incorrectly. No, that is correct. No, I remember. On the daily chart, the price is 26.81, but on the 5-minute chart, it's 26.78. And I spoke with TradeStation about that, and they just said that's the way the exchange does it. And they said that both prices are correct. Anyway, this is the close based on the 5-minute chart. I'm trading on the 5-minute chart, so I'm interested in what the numbers on the 5-minute chart are. So bulls are hoping for another trend from the open bull trend. Do we become always in short yesterday with these 2 bear bars? I don't think so. We had some gap bars here, gap between the high of the bar and the moving average. When you have gap bars late in a bull trend, it's a sign of strength on the part of the bears. They were able to put bars completely below the moving average. The rally that follows them usually attempts to form a major trend reversal. So we're testing the bull trend high, yesterday's high, on the 5-minute chart. But after gap bars, you have to assume that the bulls are going to have a hard time up here, that the bears were strong here, and they'll be looking to sell again. 60-minute chart, we're right below a bear trend line. All right, so always in long, and possibly a trend from the open bull trend. Context good enough, maybe a 25% chance this will remain the low of the day. Look at the Globex chart. All right, does that look like a bull trend, or does it look like a big bull bar in a trading range? The Globex chart, the 15-minute Globex chart, looks like a big bull bar in a trading range. We had, I forgot what it was, like 9 consecutive bull bars on the 60-minute chart over here, which is a lot. It's a sign of strong bulls, so the first reversal down usually is minor, but it's also a type of buy climax, and the market usually has to go sideways more than just a couple bars. So I think the upside is probably limited. I say that it's probably limited unless this bull trend is resuming on the daily chart. If the bull trend is resuming, we can get a series of big bull trend bars on the daily chart. So there's a slightly increased chance that we can start to get a series of big bull bars. Weekly chart, 3 dojis, 5 of the past 6 bars, dojis, bear bodies. You know, this is not a good looking buy setup. So we have a bad signal bar. The bulls need to overcome it with a really good entry bar. Therefore, if the bull trend is resuming on the weekly chart, the bulls need a very big bull trend bar this week. Will it likely happen? Look at the past 6 weeks. Okay, it's more likely that this week will look like the past 6 weeks than like something else. So it's possible that we could get a very big bull trend bar this week on the weekly chart, but it's more likely we'll get another sideways bar. All right, so always in long by the market by the close, but only a 25% chance that this will remain the low of the day. As for selling the one high, betting against the trend from the open bull trend, I need to see more before I would sell, more from the bears. We have an important magnet above that close of last year. Daily chart, you can see how many days have touched that line. So it's obviously a very important price. It also corresponds to this high. This is, I would not call that a major lower high. We have a new low, but not a series of very strong bear bars. I think this is a much more important high. So if we do get a double top bear flag, it probably will come from here and not from here. Testing the Globex high, so a big outside up bar, good for the bulls. Try to convert a trading range into trend resumption up. So bull trend, trading range, and then trend resumption up. 50% of strong moves on the open fail. So even though this looks good for the bulls, and it is, there's a 50% chance it's not going to go much higher. Remember I said 50% chance we would get follow through buying on the open. This is that 50%. But any strong move on the open, 50% chance it'll reverse. If the move is strong, the bears usually need a micro double top. And this is strong. This is like a second leg trap. One of these bars, the bar 3, bar 4, bar 5, could be a bear bar closing on its low. And if that happens, the bulls will get out and the bears will short. Gap up, strong bull bar. Here we have about a 9 or 10 bar bull micro channel. Bears wanted a second entry short. We have a pair of bear bars here, or they'll sell below that bear bar. pair of good bull bars. Bear bar closing on its low. Bulls get out, bears sell. 3 good bull bars. Bear bar closing on its low. So if we get that, the bulls will get out and the bears will sell. If it's a bear bar with a 1-tick bear body, bulls might get out, but bears will want a second entry short. Right now, everybody's buying. You can see this hesitation. We're almost halfway through this bar, and it's not making much progress. Trying to get above last week's high. Those 2 lines, last week's high, week before high, buy signal bars for a triangle on the weekly chart. So important magnet just a little bit above. Just below important magnets. While this could be the high of the day, it's more likely we're going up to 1 or more of the magnets. On the daily chart, I'll use last year's close from the daily chart, and on the 5-minute chart, I'll keep using the close on the 5-minute chart. Traders still buying, trying to get up to all of the resistance above. When you get a strong trend from the open bull trend like this, it's usually unsustainable. You know, we got one Friday. The market right now is deciding, is this the start of the bull trend resuming on the higher time frame charts? And this is consistent with that. But the bulls need, as I said, several strong trend days this week before traders will believe that the correction has ended. Gap up, 3 good bull bars, bear bar, bulls get out. If it's a decent bear bar, bears will sell. If it's only a 1-tick doji like that, a lot of the bears will wait for a second sell. Here, microdouble top, up, down, up. And that low, even though it's a bull bar, is the neckline, or you can sell below that bear bar. Four bull bars, but bear bar closing on its low. Usually good for bulls to get out, and bears can take the short, but it's not yet high probability until you start to get several bear bars. If it's a small bull bar, or if it's a 1-tick bear body, small bull bar, bulls will buy below 4. On 1-tick bull body, they might buy below 4. I would get out even if it's a 1-tick body. If it's a 2 or 3-tick bear body, I would get out of lungs. And aggressive bears could sell. If it's a 5 or 6-tick bear body closing on its low, I think it would be a reasonable sell. It's okay for the bulls to get out below 4 and then buy again above a bull bar. And for the bears, I would wait for a second entry sell. It's a decent looking bar, but not compared to the 3 bull bars. They look much stronger. For the always in bulls who did get out below 4, if they're trading always in, they're going to buy again above a bull bar. When you get these very big rallies on the open, usually the market ends up either reversing or more commonly it starts to go sideways. Here, it went up for an hour and a half before it went sideways. Here, about an hour, sideways. Here, just a few bars, and then sideways. Very strongly up, and then trading range for the remainder of the day. Market traded below the bear bar, traded up, and when it went below the low of this bar, there's a micro double top. And we might be doing something like that here. So it's a sell below 5 because that would be a second entry short. I think it would be good for the bulls who did not get short, for the bulls who did not get out below 4 to get out below 5 if it goes below 5. And bulls are hoping that we just continue up like Friday, a relentless trend from the open bull trend. Not likely. Always in bulls buy again above 5 if they get out below 4. We have a couple of targets just a little bit above. Looks like we're going to go higher. Bears want a second entry short. If they get it, that would be a higher probability sell. And the bulls, I think, will get out below a bear bar. Bulls trying to get a gap, close above 5. Bears want a bear bar, not just a bear bar, they want a big bear body. Does not look like they'll get it. So odds still favor at least slightly higher up to those 2 blue lines above, high of last week, high of the week before. Last week's a buy signal bar on the weekly chart. Failed breakout yesterday's high. Second entry sell below 6, but a bull body. I think most bulls will get out below a bear bar, 7. And most bears want to sell below a bear bar closing nearest low, possibly 7. Bulls don't mind weak bars because they saw on Friday we had a bear bar, it traded below that bear bar, and we just kept going up and up and up. So the bulls are hoping this is like this. Bars so far smaller than this. Stop for the bears who sell below 7 is above the high of the day. If we go down a bar or 2 and then form a double bottom with 5, the bears will buy back their shorts and not wait for their stop to get hit. We'll probably need a couple legs down here. If we trade down, a lot of the bulls will wait for some kind of a triangle before buying again. So 2 legs down, 1 pullback, 2. just deciding, will it close on the low or one tick tail below? Okay, here we have a 2-tick tail below. I think it's okay for the bulls to get out below. For the bears, it's not a very good looking sell setup. So a lot of the bears will wait to see if we start to get 3 or 4 bear bars and then sell. For the bulls, it's a high 1 buy signal bar, just like 4, but this is stalling up here. So a lot of the bulls are switching and looking to buy pullbacks instead of above bars. Still always in long, so still more likely bull flag than reversal and high of the day. But if the bears get a very big bear bar here, that'll become 50-50. And then if they get a third consecutive bear bar, then it becomes more likely than not that we've begun a swing down. For the bulls, double bottom 5, but I think a lot of bulls will not buy above 8. Big enough move down, a lot of the bulls will want a micro double bottom with the 8 low. And for the bears, it's a problem, right? It's still a possible high of the day, and maybe 30% chance right now. But do they get out above 8 or above 7? Probably above 7. You can see on these reversals, it's not all that clear, initially at least. You know, do you sell below the bull bar? Do you sell below this bar? Here, 3 bear bars, 4 bear bars. At some point, 3 or 4 bear bars, you conclude that we've probably begun a swing down. But initially, it's not all that clear. Decent bar for the bears, but they still need to do more. It's still always in long, so still more likely a bear leg in a bull flag or a bear leg in a trading range. Okay to be short, taking a chance is the high of the day, but not clear. Sometimes I talk about how on the daily chart, the market races up, tests yesterday's high, and reverses down. The same is true on the weekly chart and on the monthly chart. We're racing up, testing last week's high. And it's if we get a reversal down, it could be a test of last week's high, and it could be the start of a sell-off down to last week's low. Last week failed to get above the high of the prior week. So far this week has failed to get above last week's high. So good location for the bears. Their risk-reward ratio is excellent. They sell or stop above last week's high and then hold, hoping for a move down to near last week's low. Whenever the risk-reward is excellent like that, the probability is that you will lose money. Whenever the reward is much bigger than the risk, usually the stop gets hit, the risk gets hit. So it's right now more likely that we're going above last week's high. But like I said, if we get a third bear bar here, then it becomes at least 50-50, depending on what the third bear bar looks like. At least 50-50 that we've seen the high of the day. Bulls giving up. So possible high of the day, probably at least a small second leg down if this bar closes down here. This is what the bears are hoping that we get at least a little bit follow through. Get the breakout bar. Bears would like to get 2 breakout bars. Here we get 3 bars, similar to today. If you take the sell for a swing, your stop is up here because you can get a very deep pullback. Big up, big down, big confusion, and you don't know if this is a bear leg in a trading range or the start of a bear trend. And therefore you need the wide stop. %50 pullback right there. Now, what about the always in bulls? They get out below 7, and they have to buy again above a bull bar if they think the market's still always in long. When it's not clear like this, they'll want to take a second entry buy. In other words, they probably will not buy above 10 unless 10 becomes a very big bull bar. Right now, we're working on the appearance of the 60-minute bar, and we got a small double top here, third push up, 1, 2, 3, so you can call it a parabolic wedge. We're at a trend line just below an important lower high. So it makes sense there would be some hesitation here. Two bear dojis on Friday at the end of the day increase the chances that we might start to go sideways here. Let's say it's a 3-tick bull body, double bottom 5 with the 3 bear bars. I think a lot of bulls will wait for a second entry buy, or they'll wait for 3 bull bars. But even then, this is enough of a sell-off. Probably sellers somewhere above the 7 low, 50% pullback of that sell-off close of last year. So somewhere up in here, probably sellers, and a test back down to the 9 low at a minimum. Can you buy it with a limit order, betting on a bounce? The math is probably all right to do that, but when it becomes, when you get a give up bar like 9, I'm looking for shorts. Trying to get all the way back to the open of the hour. The bears would like the hour to close below its open and become a bear reversal bar. Sell the closed bears 9. We're able to make a couple points here. Bears trying to get down to the open in the final minutes of the hour, and bulls trying to get it above the open. At a minimum, the midpoint of the first hour is important. Bulls would like to close above the midpoint so they can claim they owned the bar, sign of strength, and the bears would like the first hour to close below the midpoint, and therefore they would claim that they own the bar. But if it closes around the midpoint, neither side has much of a claim of strength. Bulls micro double bottom 9 and 11, wedge 4, 9, 11, but minor reversal up, probably sellers somewhere above. Not a very good stop entry buy above 11 because it's a minor reversal. You're looking for a scalp, yet your risk is big because 11 is a big bar. Wedge bull flag for the bulls, 4, 9. Double top bear flag for the bears, 10 and 12. I think we'll probably get a couple small legs sideways to up, and then at a minimum, a test back down. "15-minute chart, bull breakout of a trading range and reversal, more likely a pullback. The bears are hoping it's a reversal, but it's more likely a pullback, and that will test a little bit up. Bears looking for a sell signal bar. They have a double top 10 and 12. And odds are, after 3 decent bear bars, we'll get a second leg down. Low on short below 12, but bull bar. Low on short below 13. If it closes on its low, the bears theoretically could sell again, but you're right above the moving average. I think the picture is confusing, and when that's the case, the market usually goes sideways. Internet connection went out. I tried one of my backups, and now I'm back on. To increase the chances that we'll go sideways rather than have a big bear trend day. Remember, I said on the open, 75% chance we would have at least a couple hours of sideways to down trading that begins before the end of the second hour. Looks like it's beginning here. Friday was an extreme buy climax day, and you have a 50% chance of some follow through buying in the first 2 hours here on the open. 75% chance you're going to go sideways to down for a couple of hours. Back down to the open of the day, trying to get back below yesterday's high and below the moving average. Bears are hoping that we do that, but we have a decent rally on the open. Even if you get the reversal, the day usually ends up being mostly a sideways day. Here we sold off strongly, but we still got to swing up. Possible second leg trap in a trading range day. This is the opposite of what took place up here. I think if 15 closes on or near its high, a lot of the bears, I think it's okay for the always in bears to get out. If it's a strong bull bar, bulls can buy at a minimum, looking for a test of the 14 high at the top of the sell climax. If it's not clearly a strong bull bar, I think a lot of the bulls will wait for a micro double bottom. Bears trying to get a measured move down here. The bears achieved, I think, their objective. We had give up bars 8 and 9, the bulls giving up. Odds were we'd get at least a small second leg down, and we've achieved that. Again, this could be the high of the day. We could sell off all day, but the bulls the bears have achieved their minimum objective of at least a small second leg down, and therefore they'll be willing to exit above 15 if it closes near its high. Big enough reversal so that the day probably will either be a bear trend day or a trading range day. I'm going to switch back to my other internet connection. Looks like it's up and working. Bulls want a double bottom at the high of yesterday. They need a pretty good buy signal bar 15. If they get it, it's an okay buy. Sometimes you'll get a big double bottom like this and then a very big bull trend day. Gap up, rally, and then 8 bear bars. And the bulls got a double bottom and a swing up. Gap up, double bottom, swing up. Gap up, double bottom, swing up. Gap up, strong reversal down, double bottom, swing up. Here we had to get a double bottom here and then another double bottom here and here. So this is what the bulls are hoping, that or this. But if they get a decent bull bar, swing bulls will buy, and I think the bears exit. So important bar. Not clear, right? I think the bears should get out about 15 and then wait. And for the bulls, it's not a perfect bar. It has a tail on top, plus the bar is big. So a lot of bulls will wait for a second entry buy. You know, they'll wait to see if we start to get a series of bull bars and then buy above a bull bar like that. Not all that clear, but at some point you start buying above bull bars, taking a chance that we've begun a swing up. You can buy above there or a second entry buy above here. When it's not clear like that, plus we have that gap below 11, it increases the chances that we'll get at least a little bit more down. Bears, I would get out above 15. And then if 16 is a bear bar closing on this low, they can sell again. Remember, the reversal down means probably either a bear trend or a trading range. And trading range, we could get a bounce way up to the top of the range, and it would still be a trading range. Bulls need to do a lot to undo what the bears did. So the bulls probably need at least several more bars before they can turn it back to always in long. For the bears, double top 12, and for the bulls, double bottom 1. I think still always in short, but the bulls are trying to get an opening reversal up from the moving average and from yesterday's high. But they need to do more over the next few bars. Market's deciding, is this going to be the low of the day, and will we rally from here? Another example. Still probably always in short. Bears need to sell again below a bear bar, maybe 17, but I would wait for a second entry short. The bulls have a reasonable argument here, and I certainly would not short below 17 unless it closed pretty much on the low of the bar and below the moving average. Without both of those things, probably buyers below. Three bull bars. While the bulls would like to get a huge bull bar, simply getting a lot of bull bars is just as good if this is going to be an opening reversal. Here, 5 bars without a bear bar, and then 7 bars out of 8 without a bear bar. That's good for the bulls. Once they get the breakout, then the odds are we've begun to swing up. For the bears, double top bear flag 13, but I would like to see a second entry short. Are we always in long yet? The bulls probably need to do a little bit more. The bears want a double top with 13, break below the neckline, measured move down. Here we got 4 bull bars, 5 out of 6, and the bears got their double top. Double tops trap bulls into thinking the market's making a reversal, and that's why the second leg up is often fairly strongly bullish. Another example. Well, this one, no one's going to buy this. The channel is so tight, but you can see a lot of bull bars. Bulls hoping that it's a strong minor reversal that would lead to a major reversal, and the bears are selling for the double top. A lot of bull bars, double top. You need the bulls to believe that they have a reversal, but if the bears start to sell around that prior high, the reversal up fails and you get the measured move down. Most recent sell climax high, 14, always a magnet when you have a sell climax. A lower high, also a magnet, so it looks like we're going at least a little higher. What happens if we go 3 or 4 ticks above the lower high 12? Well, that would increase the chances that we're going to get a bull trend from the double bottom. This bar is probably converting the market back to always in long. Bulls getting a decent breakout bar. Bears hoping for the double top, but now it's more likely that we're going to go higher. Bulls hoping that we have this. Even if we try to reverse, they're hoping that we'll continue higher. Bears want the double top bear flag. Most double top bear flags, only a 40% chance that you're going to break below the neckline and fall for a measured move down. 60% chance buyers below the reversal bar, the sell signal bar, 19. But they can go down relentlessly. Risk is small, reward is big, so you know probability is low. And that means they never look all that bearish. Double top, lower high. You can call it a lower high major trend reversal. But the 4 bull bars strong enough, and then the double bottom after the gap up, good enough. I would say less than 40% chance that the bears selling below 19 will get their swing down. So 60% chance buyers below 19 or not far below. But if it goes below 19 and gets 2, 3, 4 bear bars, the probability will increase for the bears. On the examples of double bottoms, gap is up with double bottoms. They're pretty much all the examples. There have been pullbacks. It doesn't go straight up. There's some hesitation or uncertainty early on. So pullback here. You have to assume that we'll get that here as well, maybe in the next bar or two. 40% chance we're going to get a swing down below the low of the day. 60% chance buyers not far below. In a situation like this where I think there are buyers below, but I think there's room down for 50% pullback, I don't buy the 19 low. I buy 1 point lower and 2 points lower, which is what I did. I scalped out. The sell-off was sharp enough to make me wonder if we're going to go sideways here instead of up. The pullback from the breakout of this double bottom. So we have a double bottom and bear channel. We broke above it. We have a pullback, but we're right at a prior high and a bull doji, so lower probability. I still think we're always in long, but this is not a strong enough buy signal bar for me to take that buy. Bad for the double top bears. Bulls want a gap and a measured move up, and bears now are hoping for a trading range. What about limit order bears selling 20 high, arguing not a good buy signal bar, plus the middle of a trading range day? I would not. We're always in long, so I would not sell above a bull bar in the middle of the range. So traders are either long or swing up, or I think waiting. The bears are trying to get a second entry sell, 21, a failed breakout above the double top. If they get a decent sell signal bar, 21, some bears would take the short. I would not. Some bulls will get out. I'm never opposed to getting out of a trade, because if the reversal fails, you can always get back in. That big dip, I think, is making a lot of bulls hesitate. Bears want a failed breakout above a double top. They therefore want 22 to be a bear bar, and bulls want a follow-through bar after the 21 breakout. Getting near the end of the second hour. First hour does not look bearish at all, right? Tail on top, but finished with a good bull body. Tail breakout above the double top. It's a type of a wedge. I don't know if I have a copy of one here. If it has a 2 or 3 tick bear body, I think it's okay for the Always In Bulls to get out, because we'll probably get a deeper pullback, maybe a test of the 20 low. For the bears, it's only a swing short. We're getting too many bull bars, just all, big bull bars here, bull bar here, bull bars here. It's a low probability bet that we're getting a lower high major trend reversal. Bull trend, decent leg down. Bears want the lower high major trend reversal. In general, if you have a decent sell signal bar for a major trend reversal, 40% chance you'll get a reversal into a bear trend. In general, I think this is probably less because of too many good bull bars. I had my finger on the button to sell if 22 closed on its low. It did not. Bulls still have a gap, 22 low, 19 high. They hope it leads to a measured move up. We've had several reversals today, so I think we're probably going to go below the 22 low. But we have enough bull bars to make me think that instead of a lower high major trend reversal, it'll simply be a pullback in a rally. Gap 23 low. Bulls want the measured move up, which would trigger the buy signals on the weekly chart. It'll get us above last week's high. That would trigger our buy signal. Signal would take us right to around the high of 2 weeks ago. Bears want the micro double top and the reversal down here, and bulls trying to keep the gap open and go up for the measured move. Outside down, but for the bears, if they're going to be selling, I think they're going to sell below a bear bar, and they would want 24 to close on or near its low. Otherwise, still always in the long. This looks more like a leg in a trading range than the start of a bull trend. The pullback on 20 is especially big. The bulls had a reasonable buy above 23 with a gap above 18, and we went outside down. So still more likely up than down, but it does not look like it's going to go up all that far. Close of the second hour, we have a bull inside bar and a bull trend with a magnet above. So it looks like we'll probably go above this hour's high, but I'm not confident that we're going a lot higher. Most bears would not sell below 23 bull bar, always in long. But if they get a second sell signal, let's say 25 is a bear inside bar closing on its low, it'll be similar to 7, and more bears would be willing to take that short. It would have been better if the bears got a small inside bar 25. Here, they're being forced to sell below a doji, just above the moving average, and I think most bears do not want to take that short. Still always in long. Theoretically, if bulls get out below 22 or 25, they have to buy again above the bull bar, but I think most bulls would only consider buying above 26 if it closed on its high. Otherwise, they'll wait to see if we go sideways for a few bars and then take a micro level bottom, maybe 26 and 28. Whenever patterns do not look very good, if there's some glaring problem, the probability is the pattern will fail. The bears have a lower high major trend reversal. Bad sell signal bar 22, 23, 24. 25 closing on its low, but a big bar just above the moving average. All of that, I think, reduces the chances that this is the start of a swing down. And a lot of the bears will wait for more evidence that the bears are in control. For example, 3 consecutive bear bars or a very big bear bar. I said a lot of the bulls did not want to buy above 26 and they'd want a micro double bottom. Well, let's see if they can get one with 28. Will 28 be a bull bar closing on its high? If not, then we're probably going to come down and test the 20 low. Spending a lot of time in the middle of the day's range here increases the chances of more sideways for the bears, lower high major trend reversal, but they need to get consecutive decent bear bars before traders believe that the market is going down. And the bulls trying to get a higher low. 25, big enough to get a second leg down. 27 might be it, but bulls, I think the bears will get out above 27 if it closes on its high. Some bulls will buy above 27, taking a chance that we're going up. Still always in long, so the odds still favor up, but it would not take much from the bears to flip it. Not a good buy signal bar for the bulls, not a good follow through bar for the bears. Odds still are we're going higher, but we may have to test the 20 low before the bulls come back. Nothing is looking as good as either the bulls or bears want. Math slightly favors the bulls. So what do the always in bulls do if they get out below, let's say 25? Well, they now have a micro double bottom. Theoretically, I think they have to buy again above 29. This is not a very good swing trading market, but that's where I think the bulls get long again. And what about the major trend reversal bears? What do? I would get out above 29, but they could put a stop above 22. Reversing up from the moving average, moving average, moving average. Subtle but important. A lot of times bull trends begin with subtle signs of strength, such as holding above the moving average. The bears theoretically have stops above 22. Not necessarily one tick above, maybe 2 or 3 ticks above, but certainly somewhere above. The bulls know that, and they want to get a break above 22, and then they'll try to get a measured move up from the 29 low to the 22 high. Bears are simply trying to prevent the bulls from getting the breakout the bears will try to get a double top lower high 22. What do you do with the negative with a bear bar 31? It's still on the major trend reversal short, although I would not be short. It's a problem for the bulls. The bulls have higher lows, which is good, but they also have lower highs, which is bad. They need to break above 22, similar to the daily and weekly chart, triangle with higher lows and lower highs. But unless they get the strong breakout, it's still not much better than 50-50 in favor of the bulls. And the same here. Always in long, but not a lot better than 50-50 unless we break strongly above 22. Traders are scalping, and that's why the market is not going very far. They don't believe it's going to go very far, so they're taking quick profits. So if the bears sell and take quick profits, we go up. If the bulls sell and take quick profits on a rally, we go down. A lot of trading range trading, so we should get above 22 to flush the bears out. I think we're probably going to go up to last week's high to try to trigger the buy signal on the weekly chart. But this is not behaving like a strong trend day. When you get these gap up days with a good rally and then a deep pullback, yes, the market's always in long, but it usually does not become a huge bull trend when you get these deep pullbacks. Here, it did become a pretty good bull trend, basically a trending trading range day, lower range, breakout, upper range. Here, we've got about a measured move up, holding above the moving average, many more bull bars than today. Bullish probably will get a new high, but I don't think it's going to become a big bull trend day. Remember I said that 75% chance we would trade sideways to down for at least a couple hours, beginning by the end of the second hour. Maybe it began bar 4, and we've achieved that minimum goal. It's possible that we stay sideways all day. Not a lot of traders wanting to buy high, and certainly they're not eager to buy above a bear bar, even though there are magnets above 22 high of the day and the high of last week. Good breakout for the bulls. They want a new high of the day, and they especially want to get above last week's high, which I think they will. So rally, but weak rally. Bears want a low 2 short, so low 1 here below 22, and then low 2 below 35. Also a wedge 25, 30. And if 35 is a decent bear bar, I think traders will sell. Getting near the end of the third hour, and so far 3 bull bars. We're breaking above the second hour high, so it's a high 1 buy, but right near resistance and not a strong buy signal bar, a doji inside bar, and the first bar had that tail on top. So the rally is losing momentum. So instead of big bull bars closing near their highs, we're getting smaller bars and prominent tails. Market's trying to transition into a trading range. Usually when there's a lot of trading range trading like this, I don't like to be buying with stops at the top. I look to buy pullbacks and I scalp. Terrible bar for the bulls. And it's not all that good for the bears. I had my finger on the button. No, not quite, but I wanted to short below 35 if it was not a very big bear bar. And instead, it's similar to bar 20, a very big bar, like 14, very big bar. And selling at the bottom of very big bars in a day that's mostly sideways is a bad strategy. Selling below 14, selling 20 as it was forming, difficult strategy. And the same with selling below 34 or below 35. You can see we went above last hour's high, and there were more sellers than buyers above. 60-minute chart, hard to see, but we went a little above last hour's high to trigger the buy signal for a high 1 bull flag. And this is last hour's high, 522, and there were more sellers than buyers there. Behaving more like a trading range day than a bull trend day. It's obviously a bull trend day, and we have higher lows and bull bars, and we're holding above the moving average. But it's also a trading range day, and the bears are still hoping that 7 will remain the high of the day. They now see they had a lower high major trend reversal here. Now they have another attempt at a lower high major trend reversal here. They want to break below the neckline of this double top and a measured move down. Still always in long, but I did nothing here. I was hoping for a bear bar 35 to sell below, did not get it. We have still not broken out of the first 18 bar range. Here's bar 18, did not go above the top of the range, did not go below the bottom of the range. Still in breakout mode. Well, now the bulls are looking to buy again. If they get a bull inside bar 36 and the bar is not too big, it'll be a buy setup. What do the bulls do? I think it's bad to be swing trading right here. I'm currently flat, willing to buy, willing to sell. Theoretically, some bulls get out below 32. They had to buy again above 33, and they put their stop below 29, and they get out below a bear bar 35. So theoretically, the bulls who bought above 33 are still long. And for the bears, they have a lower high major trend reversal, but they want to sell below a bear bar, which is 35, and I would not take that sell. It's in the middle of a trading range day, and it's at the bottom of a 6-bar expanding triangle. Remember, 35 triggered a buy signal on the 60-minute chart and went above last hour's high, and the bulls see 35 as simply a pullback from that buy signal. So it's theoretically still in that 60-minute buy, but really not good enough to attract a lot of bulls buying above 36. Suppose it's a bear inside bar closing on its low. I think it'd be a swing short. I'm not sure that the math is worth a scalp. Look at the past 7 bars, tight trading range, and selling with stops, buying with stops. I think the math is not worth it for a scalp. At this price, close of last year, we sold off, and we're stalling, might sell off again. Suppose we go sideways for a few more bars and start to get some bull bars closing on their highs above the moving average. I think the bulls will be more willing to buy. Continuing to fail back to the close of last year. Bears not getting good sell signal bars here. 22, 25 too big, 35 big outside doji, 38 a bull doji, and plus we're still getting mostly closes above the moving average. So while the bears have an argument, they do not yet have a high probability setup. Limit order trading in here. Most traders should wait. You can be short. I would not be short. You could be long, which I think is better if you're trading always in. I think the market is long. The problem the bulls have is stop placement. Below 29, maybe you might have to put the stop all the way below 15, the bottom of the rally. So not not very good environment for swing trading. Most traders are scalping. And right now it's not very good for scalping unless you're willing to trade with limit orders. Most traders should just patiently wait for a better buy signal. Maybe we go sideways and we get a small bull bar closing a little bit above the moving average, or for a strong bear breakout with follow through. Another close below the moving average, like 14 and 27. But the bears did not get consecutive closes below the moving average. They'll try to do that here. They want the market to get back down to the low of the day, or at least the open of the day. I think the open of the day is probably the most important target. Whenever you have a trading range day, the open of the day is always a magnet, especially after 10 or 11 o'clock. The market usually trades. If the bulls are trying to get a bull trend day and they're clearly failing, the market usually has to come down and test the open. So if the bulls do not break to the upside sometime in the next 30 minutes or so, we're probably going to get down to the open. We might just go straight down to the open, but if we simply go sideways and continue the trading range, the odds are we'll come down to the open and then decide what to do. We may close the day around the open. We may close the day at the high. We might close the day at the low. Friday, we had a good Thursday, good buy signal bar. Friday, good bull buy entry bar, but right at a lower high plus another major lower high just a little bit higher. So the bulls need to break strongly, especially above this high. If they do not, then the trading range is still in effect, and the probability for the bulls is not much greater than for the bears. Someone posted a question the other day on the Bricks Trading Course website about buying calls right here. He said, well, we got a good reversal, we got a wedge, we got a double bottom, we have a higher low. The monthly chart looks okay. Is this a good place to buy calls? And my response to him was, we're still in a trading range. And if a person's buying calls, they want to be buying calls near the bottom. If the market's near the top and they're looking to put on an option trade, they should be buying puts. If you're buying after a move begins, it's usually better not to buy calls. If you're buying after a rally begins, it's usually better to buy call spreads because the volatility is higher. You got more premium uncertainty. Whenever the market moves, there's an increased chance of more movement, and the price of options goes up. So if you're buying at the top of a trading range, based upon the reversal and the double bottom, you still haven't broken to the upside yet. If you're buying high with calls, I think you buy call spreads, and I personally would not buy calls this high up. The place to buy calls is down here near the bottom of the range. It doesn't matter if you're trading options or stocks or futures. Everyone wants, or the bulls all want the bull trend to resume. But if you're buying, it's better to be buying. It's a limit order market. It's better to be buying, below bars or as the market's trying to reverse up, and not after you've had a reversal up, because we've had lots of reversals that have lasted 2 or 3 days and then went the other way. So buying calls up here is an example of buying too high in a trading range. Bulls inside bar, high 236, but 2 big bear bars. I'm not going to take that buy. It looks like we're going to try to get down to the open of the day. What about selling here? Well, the bears have a big. They have 2 problems. They have a bull bar 41 and a big tail 40. Plus, we're making lower highs, and there's no energy in the market. So that'll make a lot of bears unwilling to sell below 41, a low one, bear flag at the bottom of a pretty tight range here, and a bull bar, and then a big tail here. Limit order market, so probably more buyers than sellers, 41 low. Even though we have a magnet at the open of the day, and even though I think we're going down to the open of the day, I don't know if we go sideways more first, go up a little bit first, but I think we're going down to the open of the day. We have a low one sell and a bull bar at the bottom of the trading range. I think it's an okay scalp. When you have a low two, even if it's a bull bar, I usually do not take that buy. The bulls should not allow a low two to trigger, especially when there's a magnet just below. The bears still have their lower high major trend reversal, but the sell-off looks like a bear leg on a trading range day, just like this looked like a bull leg in a trading range day. We should get down to the open. At a minimum, we should get to within one tick of it. You know, it's still possible that we go sideways first, but I think this is probably the beginning of the move down to the open. It's possible we could break below the neckline of this double top and fall for a measured move down and go outside down, but extremely unlikely. Friday was a huge day, and we don't have that much time in the left in the day. It's possible we can get down to 78, a measured move down from a double top. But even then, right now, I suspect that will not happen. Measured move down takes us to around 78. Because of that magnet down at the open of the day, I think a lot of the bulls are hesitant to buy. We're close enough to the magnet so that we probably have to get there. Another bar, big tail on the bottom, like 40, 42, but important magnet, not far below. Suppose 45 is a big bull bar closing on its high. I think the bears might give up. However, I think the best the bears will get is a bounce, maybe a double top 43. We're so close to the open of the day, and the day has been a trading range day. And when that is the case, you know, probably about a 70% chance we have to get to within a tick of the open. Trading range day came down to the open, it reversed up. Trading range day came down to the open, reversed up. See, we got exactly to the open. It can also come from below and reverse down. Test from below, got back to the open, reverse down. Here it came down from above, bounced, and then broke to the downside. The point I'm trying to make is pretty much anything can happen, and the probability of one outcome is really not much different from any other. Trading range day, it kept testing the open of the day and closed right around the open. It bounced after a dramatic sell-off, went below the open, got back and closed right around the open, closed exactly at the open, bounced up, collapsed below, resistance at the open, sold off, came back to the open. Everyone wants high probability, but it's just not going to happen in a trading range day. So odds are, even if we bounce here, we're going to get down to the open. If we bounce, then we might get down to the open at 11:30 instead of at 10:30. And once we get to the open, we'll probably bounce. For the bulls, wedge pullback 35.40. but they have a problem. The channel is pretty tight, and the big problem is the open of the day. I don't think we're going to be able to escape the magnetic pull. Even if we reverse up 2 or 3 points, I suspect that. I believe we're going to come down to the open. If we reverse up and get a double bottom 29, double bottom 20, and break above the neckline 35, then no. Then we'll get trend resumption up. We have a bull trend, a trading range. Bulls want trend resumption up. Bears want trend reversal down. Right now, it's most likely we will get neither. That will test the open of the day and then close a few points above it, a few points below it. Not much energy today, so probably not going to go all that far up or down. Another low 2 bear flag like 43, also a bull bar like 43. I think most bears are not going to take that sell, even with the magnet of the open of the day just below. I think we never went always in short after we reversed up on 18. So it's still slightly more likely that we'll get trend resumption up, bull trend, trading range, trend resumption up, and it's slightly less likely that the head and shoulders top results in a trend reversal down. This could be strong enough so that we do not come down to the open. Bulls probably need one more bull bar on 49 to make traders give up on the open and to conclude that we're getting trend resumption up. Five consecutive bull bars. So it looks like trend resumption up. People buying, they have their stop below 46 or 44. They believe this rally is strong enough to break above the neckline of the double top, or excuse me, of the double bottom. We have a double bottom here or here and here. But because of the trading range, anyone buying high needs a wide stop. Probably better if they can scale in lower. Bears will want some kind of a micro double top like here or here. For the bears, low 245, head and shoulders top, left shoulder, head, right shoulder, at 5 bull bars, probably more buyers than sellers below 50. Bears trying to get a good sell signal bar, but probably they'll need a micro double top. The bear bar is a reminder that we're still in a trading range. We have not yet broken out, but the 5 bull bars make it likely that we're going to go up to a new high. Micro double top up 50, down, excuse me, up 49, down 50, up 51, possibly down 51. Without the micro double top, I think it would be fine to buy the 50 low, the limit order. Because of the micro double top and the magnet at the open of the day, I think a lot of bulls will not buy the 50 low. Still always in long, and bulls have 5 bull bars, but they should not have allowed 50. And now a lot of bulls will wait to buy either sideways for a few bars or after they see the breakout. And for the bears, it's still on the head and shoulders top and lower high major trend reversal sell. But with the 5 bull bars, I would not be short. The probability is not high enough. Bear is trying to create a credible short. Well, I think the 5 bull bars will make most bulls not, most traders not look to sell. Always in bulls, will they get out below a bear bar 52? I think it's okay to get out at the top half of a trading range day, and then wait to see if we go sideways for a few bars and get another buy signal bar. And for the bears, I don't know that the math is, I don't think the probability is good enough for a scalp short. You can do the swing short, but I would not with the 5 bull bars and now a 7 bar bull microchannel. Always in long, high 2, but bear bar, opposite of 43, which was a low 2 with a bear bar. We did not get very far. .43 is a low 2 with a bull body. 52 is a high 2 with a bear body. Not strong setups. Another breakout bull might buy, but 25, 44, 20, the bulls are aware that we can reverse down pretty sharply, and they're hesitant to buy high. We were sideways here for about an hour, half hour here. We're at that same price. I think most traders should just wait. I still have that line there for the open of the day because it's still a magnet unless the bulls get trend resumption here, unless they break fairly strongly above the top of the range. The longer we fail to get breakout, the higher the probability is that we come down to the open. Bull trend, trading range, and then a pair of breakout bars, trend resumption up. Trading range for a lot of hours, and then a pair of breakout bars, and we went a little bit higher end of the day. Same here, a little bit up at the end of the day. This is over 3 days, so it's comparable to what we have today. We had a big rally yesterday, and then if we have a trading range today, the bulls can try to get trend resumption up tomorrow if they do not get it today. Rally, trading range, and then breakout. Maybe 3 small bull bars like this. Traders start to just buy at the market. Rally, trading range, breakout attempt, really very little up there. Very strong upside move. Sideways for a few hours and then a breakout follow through and a little bit more up, trend resumption up. This is over 2 days. Rally, trading range, and then the second day we got trend resumption up. The bulls want as big a bar as possible. The bigger this bar is, the more it closes on its high, the more likely we're getting trend resumption up. And the less big it is, and the bigger the tail on top, the more likely we're getting a double bottom and we're going down to the open. Swing bulls are buying, looking for a measured move up. Minimum target is high of last week. Last week is a buy signal bar on the weekly chart. It's a doji bar and a bear body, not a high probability buy, but it still is a buy signal bar. And I think we have to get above its high either today or tomorrow. It's a good enough buy signal setup in a bull trend. I think traders want to know what's there. The bears want to know what's there as well. They want to know if they can have the bulls get long and then overwhelm the bulls and reverse it down. Can the bulls put a stop below 57, below 58? They probably can, because if it's going to be a successful breakout, it certainly should not come back below 57. If 59 is a bear bar, they'll get out below 59. If 59 is another decent bull bar, then we're probably going up for a measured move. Important bar, right? Will the bulls get a big bull bar? Does not look like it. And therefore, you got to be thinking that maybe the bears will get a bear bar, in which case a lot of the bulls will get out below 59. And if it's a big enough bear bar, like 7, you'll get bears shorting, looking for a swing down. This is an example of every tick matters. A 1 tick bear body might be enough to make bulls give up below 59. And therefore, the bulls want either a perfect doji closing at the open of the bar, or they want a bull body. Both would increase the chances that we're going higher. While not a very big breakout, it's a breakout and follow through, and not a strong short below 59. Probably buyers below 59. The bears want to sell below a bear bar. If 60 is a bear bar, they'll sell below 60, but most bears are not going to sell below 59. Probably buyers below 59. So 60 probably is like 20. Brief sell-off, 35, 40, 44. We've had lots of brief sell-offs that reversed up, and right now this is likely to reverse up. If it closes on its low, especially if there's another bear bar, then we've probably seen the high of the day, and we're probably going down to the open. For bears to take the short, I think they want to see a bear bar like 7 or 39. Otherwise, the bulls will continue to swing up, trying to trigger the buy signals on the weekly chart. The market's deciding, are we going down to the open, or are we going to trigger the buy signals on the weekly chart? We have a gap between the bodies, so the math is still okay for a possible measured move up. Let me look at ticks. Now we hit plus 700, which is decent, but not the same as 1,000. Did not get to 1,000 up or down today. on these trend resumption up days, most of them, the trend up is not all that strong. Here, it does not look like it's going very far up. Sometimes you get a very strong breakout, 5, 6, 7 bull bars, but that's not what we're getting today. We're getting more of this kind of stuff. So right now, I'm not sure that we're going a lot higher. Today's breakout is not as strong as that. Trying to trigger the buy signal by going above last week's high. And even if it triggers, that does not mean we're going up very far. The market is simply checking to see if there are more buyers or sellers above last week's high. And then also the high from 2 weeks ago as well. On the weekly chart, we have a pair of dojis. We have a microdouble bottom and a triangle. So last week's high is a buy signal. Not a strong rally. We're not getting consecutive big bull bars. And this looks like a bull leg in a trading range. So we're probably going to get some reversal down. I don't know if we go all the way down to the open. Right now, it does not look like it. It looks like we're going to go above last week's high to see what's there. Parabolic wedge 54, 58. If 62 is a bear bar that has a 2 or 3 tick bear body, I think a lot of the bulls will get out. And bears will they short? They might. Tight bull channel, so even if it has a bear body, minor reversal and pullback more likely than a bear trend. But if it has a 2, 3, 4 tick bear body, I think the bulls will get out below. How would you get out below 62? Tight channel, so not a high probability sell, but okay swing sell, looking to get down to the open of the day. Similar to 14, right? Similar to 20, reversed up, big sell-off, and 44. You can see the bears so far unable to get below 62. Tells you a lot of the bulls bought the close. As soon as they saw the bear close, they hit buy the market. They're trying to prevent the market from going below 62 because they know a lot of bulls will give up below 62, and those bulls might not buy for the rest of the day. And that will reduce the chances of this continuing up. Nobody wants to sell too low, and nobody wants to buy too high. So there's still trading range mentality going on here. I just sold. Market's trying to get down to the open. whenever I sell and the market's not clearly in a trend, whenever I take any trade, I usually scalp. And here the move is big enough for a 2-point scalp, but I'll look to sell again if I can get an opportunity. What about buying, betting on at the end of the day, bear trap? Now, I need to see a pretty good reversal on the part of the bulls to buy. Right now, it looks like we're going to try to get down to the open. Strong rally, end of the day, came down to the open. Strong rally, late in the day, came down to the open. Strong rally, got down to the open. Sometimes you get a big sell-off late in the day and it traps bears into hoping that the day's going to become a bear trend and the market just reverses back up. Sometimes it can happen in our trading range. So a trading range, a few big bear bars, bears think they're getting down to the open and does not get there. Are we always in short yet? I don't think so, but if 64 is a bear bar, especially if it closes near its low, then we probably are. If it's a bull bar closing on its high, then I think we're not. But I think any kind of a bear bar, even a one-tick bear bar, would be enough for traders to conclude that we're always in short. Every tick matters. So if the bears get even a one-tick bear body, we're probably always in short. And it would increase the chances that we're going down to the open. So I think we're always in short. Consecutive closes below the moving average. But trading range day, so just like the bulls were disappointed by the follow through after a bull bar here and here, the bears could get disappointed by the bad follow through on 65. In other words, 65 could be a bull bar. So what happens? What happens now? I said that. I showed it earlier. When you have a trading range day and it tests the open of the day, it can do anything, and the probability of the three options is about the same. It can rally and close near the high. It can sell off and close near the low, or it can just close around the open of the day, and the day becomes a doji bar on a daily chart. Good place for bears to take profits. Because when you get these tests of the open, even if they're sharp, you usually get some kind of a bounce. Went through it strongly, but still came back to it. What about selling closes down here? I would not, because it's a trading range day. And even though the sell-off is unusually big, the odds are we'll bounce somewhere around here. You know, maybe right where we are, maybe a little bit below. Big sell-off, bounced. First time down, bounced. Big sell-off, bounced, tried to get back up to the high. It came back down below the open again later in the day. Sometimes you just hear, well, this is a test of the open here, and then we just sold off into a bear trend. Collapsed down to the open of the day. Still went back up to a new high despite 5 bear bars. Big sell-off below the open, got a second leg down, reversed up. Big sell-off to the open of the day, sideways and then up. What about buying? Buying above 66. With the 4 bear bars, I would not buy above 66. I think the bulls need a micro double bottom. What about selling below 66, a low one? Well, it's similar to 41 or 45. Probably not a lot more down before we bounce. So sideways to up likely, either starting now or after one more push down. Always in short, probably seen the high of the day, probably 70% chance we've seen the high of the day. Maybe 80%, 20 or 30% chance we'll work all the way back up there again. Like this, big sell-off, 3 bars, 5 bars, still got back up to the high. Did not get above it. $60 minute chart, big outside down. You can't see, but it's 1 tick below last week's high. Low one short, but a bull body and at support. So not a strong sell. Always in short, but we may have to get closer to the moving average before the bears will sell again. So far, I think okay for the Bears to get out above 66 or 67, and for the Bulls, the math I think is a little bit difficult. You know, your risk is probably greater than your reward, and the probability is not very high. Low one, but at support, and a bull II. And for the Bulls, they're hoping it's a bear trap and that we reverse up to the high of the day. I showed in those examples that anything can happen here, and the probability for a bear trend, bull trend, and a doji close is about the same. So even though it's a strong sell-off, we could still rally back up toward the high. Always in short, slightly more likely that we'll go lower, but it's not a high probability bet. Open of the day, bounced. We have an II here, a little bit of a bounced, but ultimately sold off. Low one, below 68, but three small bars at support, not a good stop entry environment for scalpers. You know, what do the bulls who bought above 67 do? Well, I think they have to get out below 67 or below 68 if 68 has a bear body. And for the bears, it's a low one short, but you know, how far down will we go? I'm not confident that we're going to go all the way down to the 60-minute moving average. Low one short, but fairly big tail. It's still on a buy above 67, but I think most traders should be flat and waiting. Still always in short, but not a good sell signal bar. It worked, bar 13, a low one with the doji. Testing the 15 low, and next is open of the day. Excuse me, the low of the day. What happens if we get below it? Will there be a lot of stop orders there? I don't know. Yeah, I suspect that even though we're falling quickly, we're going to stabilize within a bar or two. Daily chart. You know, I talked about this over the weekend, that the bulls need really good follow through this week. Otherwise, the past 2 days were just a couple of days in a trading range. And we had a couple bear days, we had a couple bull days, a couple more bull days. Traders are selling because of the trading range day. I sell, I scalp, and then I look for something else. Buy the close. Bulls made their scalp. I thought about it and I hesitated and I missed it. If the bulls get a good bar. It's 2 legs down in a trading range. I think bears will get out above 70 if it closes near its high, and bull scalpers will buy looking for a test to the top of the sell climax high, 69 high, just like 14, second leg down, 1 pullback, 2 bull bar. They bought above looking for a test of the sell climax high. Right now, 90% certain we're not going to go up to the high of the day. So even if we rally, we'll probably have a hard time getting much above the 69 high. Bears want a measured move down. Takes us to the 60-minute moving average. And bulls want a failed breakout of the low of the day, test of yesterday's close. They want to get back above the open of the day. Final second, bears unable to get a bear body for the follow through. For the bulls, second leg down and micro double bottom, but not a very good stop entry buy. For the bears, should they get out above 71? I would get out maybe 4 or 5 ticks above 71. Bears get out above any bull, above any bull bar, and maybe 3, 4, 5 ticks above any bar, including 71. I would probably get out here. It's a trading range day. Open of the day is a magnet, and we have a sell climax, a second leg down, and then we have a micro double bottom. It's always possible this could become a bear trend day. It's just not likely. We've been in a trading range day for 68 bars, and open of the day is still a magnet. It pulled the market down. It probably will pull the market up before the end of the day. Getting near to the end of the hour, and big outside down bar traded above last hour's high and below last hour's low. Bears want a double top with last week's high, and then a sell-off below the neckline and a 100-point measured move down, more likely sideways. The bears double top 70, still always in short. Some bears are still short. They want to get out above a bull bar. I would get out above 72, if not already out above 71. Because it's a trading range day, open of the day is still a magnet. For the bears, a low one, still always in short, double top 70. I don't know that the probability is high enough for a scalp short. You can take a chance for a swing, but I think we'll have a hard time falling much below the 60-minute moving average and the measured move down if we get there. And if 73 does not close close to its low, there probably will be buyers below. Again, trading range day, open of the day is still a magnet. Strong sell-off below the open, got back to the open. Relentless sell-off, strong sell-off below the open, got back to the open at the end of the day. Not great to chase it up unless it becomes a lot stronger. Chances are we'll have a hard time getting above the 69 sell climax high if we get there. This might end up being a limit order finish, buyers below, sellers above. I think it's a difficult finish because it's a big up, big down, big up finish. Makes trading range likely, and trading range traders tend to trade more with limit orders. I don't think traders should be trading with limit orders in the final half hour of the day. So it might be, we might not get any more decent trades. Bulls, they can be holding for a swing up here or higher, but I think we're going to have a hard time getting much above the open. And for the bears, they have to be out of shorts, and I don't know if they'll get another short today. 72, 73, strong enough, so a lot of the bears will want a micro double top, which would take several bars, and the day would be just about over. When we sold off, there were buyers exactly at the open of the day, and now we're rallying, and we're pausing at the open of the day. Not a good sell signal bar, even though we're at resistance, and not very good by the close. We're right at resistance. Open of the day, moving average, and 69 high. So probably better to do nothing. Probably sellers below 73, and this may end up being a limit order type of finish. So what do you do if it's a bear IOI? It's also a 4-bar tight trading range with only a few bars left to the day, and the day is exactly at the most important price of the day, the open of the day. So not good trading. I rarely ever take limit order trades at the end of the day like this, but I did buy the 74 low. And I thought there was enough time to scale in lower if I had to, and the odds were pretty high that we would not fall below the 71 low without getting back to the 74 low. So you buy the 74 low, buy more, maybe a couple points lower, stop down here, and I would say, I don't know, 75% chance we would get back to the 74 low, and that would allow traders to get on break even on their first buy and with a profit on their lower buy. Turns out we just went straight up, so it was a quick buy and scalp out. The fight now is over the appearance of the chart on the daily chart. Will today close below the open, in which case tomorrow we'll look at today as a sell signal bar, a credible sell signal bar. If the bulls can get today's close above the open, then today on the daily chart will not be a particularly good sell signal bar. We still don't know if that it'll close above the open. On the daily chart, the bulls want to get as many bull bars in a row as they can get, even if a couple of them are small. So it's helpful to the bulls to get a bull bar today. And right now, I think we're going above last week's high here. I think we're going to go up here over the next week or two, and then find out if we're going to form a double top, break below the neckline, and sell off for a measure move down, or break strongly above it and then test 2,800, this high, and then the all-time high. The market's trying to decide if the correction is over and the bull trend has resumed, or if the correction has more to go. If it does have more to go, I think if we start to go down, right now I think there's a 40% chance we'll break below this double bottom. Maybe leg one, leg two, leg one, pull back, and then sideways and leg two. Friday, extremely strong bull trend day. 50% chance we'd get follow through buying in the first couple of hours. We got it on the open. 75% chance we'll have at least a couple hours of sideways to down trading. That starts by the end of the second hour, and it started on bar 4 and lasted most of the day. The bulls tried to get trend resumption up. So Friday, bull trend, trading range, tried to get trend resumption up. It failed. We got trend reversal down. Whenever you have a trading range day and you're above the open or below the open is a magnet. And we were above the open. We got drawn down to the open. We fell below it. And we got drawn back up to it. It looks like we'll close right around the open of the day. On Friday, we had a trend from the open, bull trend. 5 bars up around the open. Today we had 3 bars up, and only 25% chance today would be another very strong bull trend day. So much more likely that if we do go up strongly on the open, which we did, we'll soon enter a trading range or reverse. First bar of the day, we were always in long at the end of Friday, so we're always in long. First bar of the day. Second, third bar of the day, always in long. Bar 4, a failed breakout, yesterday's high, but it's the first signal. And with the 3 good bull bars, the bears need either a second signal, which they got below 7, or they need 3 consecutive bear bars, which they did not get with bar 4. We got the 3 bear bars, bar 9, probably going down for at least a small second leg. Reversed up 15, possible low of the day, opening reversal up from support, double bottom with 1, and we rallied for a few hours. We tried to break above the top of the day. The breakout bar 58, okay size, follow through bar 59, okay, and 61, okay as well. It turned out it was a buy vacuum test of last week's high. We failed to get above last week's high, therefore we failed to trigger the buy signal on the weekly chart, and we reversed down on 62. Okay to sell out of longs below 62, okay to go short for test of the open of the day. Higher probability, wait for a second or third bear bar. I thought the market was always in short on 63 or 64. We tried to bounce from the open 66, but not a very good buy signal bar, 66, and strong enough sell-off, probably we'll get a second leg down, which we did on 69. And the bulls got a micro double bottom, 70, 71. Not a good buy signal bar, 71, bear body, but I suspect we're going to try to get back to the open. 72, if the bears did not get out above 71, they get out above 72, and the bulls buy for a test of the open. Stop entries today, above 1 made sense, below 7, okay, but not great. Below 13, probably not going a lot lower. Above 15, certainly a good swing buy. Double bottom 1, opening reversal up from the moving average after a gap up. Above 20, doesn't look very good. Big reversal on 20. Reversal went down and up, and then a doji buy signal bar. Looks like we may try to get a lower high. And then selling below 25, it's too low to be selling after a rally that is as strong as this. This is too strong to be selling that far below. Buying above 29 for double bottom 20. You call it a wedge with 24, 25, and 27 and 28. Not really good looking buy. Looks like we're entering a tight trading range. For the bears, lower high major trend reversal 25, second entry 32, third entry below 39. Why are the bears not getting a good sell signal bar, and why are they not getting 3 consecutive strong bear bars? It's because this is probably not going to be a major reversal. Bulls, they had a buy above 42, micro double bottom 40, a double bottom 35, other computers double bottom 29, and then we had a better wedge buy with 46, micro double bottom, high 2 with 41, a wedge with 35 and 40. 4 bull bars, probably going higher. Bears tried to reverse below 55, but a bull bar, and then they tried to reverse again below 61, not good. Stop entry below 62. Let me go back to stop entry buys. Buying above 52, might be sellers at the 35 high for double top. So not good buys above 51, 52, and 56, 57, and 60. None of them was particularly good. For the bears, swing short below 62, scalp, maybe, I don't know, I'd rather be swing trading. And then big reversal, 63, 64. Bears will sell below 63, below 64. Bulls, they're trying to reverse up from the open of the day, 67 and II. I would not buy it. Probably sellers above 68, a low one short, but 3 dojis right at the open of the day. I think we'll go down a little bit more, but I don't think we'll get down to the 60-minute moving average. So if you sell below 68, you're probably scalping. Buying above 72, micro double bottom, 70, 71. Sell climax, 69. 2 legs down in a trading range day. Open of the day magnet above, so probably going a little bit higher. Buy the close, sell the close. Well, 1 close, traders probably bought it, and then 2, 3, 4 close, they bought it. 9, 3 consecutive bear bars, probably going lower, they sold it. And then 17, 18, 3 bull bars, 4 bull bars, probably okay, buy the close, looking for a trend up, double bottom, 1, 15. And then we had limit order trading, where traders are doing the opposite, buying bear closes 25, selling bull closes 30, 31, 36. Over here, sell the close, maybe 63, but definitely 64, 65. 69, probably going a little bit lower, but a huge bear bar. Probably more traders buying the close than selling the close. And then buy the close, 73, 74, but not much more up. Limit order trading, the 4 low, probably the bears needed a second entry short, and therefore bulls would buy the 4 low. And then we had 3 bear bars, 9. A lot of traders would sell the 11 high because it's a bad looking buy setup. Wedge with 4 and 8, but 3 bear bars, 5 bar or 6 bar bear micro channel. And then here, probably buyers below 19, but I thought a disappointing size of the sell-off 20, and it increased the chances of the market going sideways. And then through here, it's just limit order trading, selling above things, buying below things, and scalping. 32, 37, not good looking buy setups, so sellers above 25, 28, 41, 43, 45, not good looking. Sell setups at the bottom of the range, so probably buyers below. And then up here, not a good sell setup, 53, 55, buyers below. 67, I did not buy above, I did not sell below. We're testing the open. I thought we'd get a second leg down. And then 74, probably buyers below. All right, so the bears now hope this is a double top, 68, 79, and they want to break below the neckline and fall for a measured move down. Today, even if it has a small bull body, right now it has a small bear body, it'll still be a sell signal bar for tomorrow. Basically a doji double top with last week's high, but not a very good looking sell signal bar, more likely buyers below. The bears want the double top to lead to a sell off below the neckline, and then a sell up for a measured move down. It looks like just another doji in a 2-week trading range that has many dojis. So not good follow through for the bulls, not good sell signal for the bears. Weekly chart, we did not go above last week's high, and we did not therefore trigger the buy signal on the weekly chart. But when you look at it, 3 bear dojis, and then 3 other small bars, maybe dojis. This is not good stop entry trading. So even if tomorrow we go above last week's high, it's not a strong buy setup. Do you think the New York Stock Exchange advances minus decliners is of any use to beginners? I noticed that it led the breakout on bar 58. No, I would not pay any. For years, I paid attention to it, right? But I think as a trader, you're wasting your time. When you say, he says, I noticed that it led to a breakout at bar 58. My reaction is, who cares? Half the time, it's like flipping a coin. If you flip a coin and you see heads and then the market goes up, if you say, oh, every time I flip that coin, if I see heads, I'm going to buy. I think that's how useful the advanced decline line is to day traders. I think it's useless and it will cost you money. And even if it does occasionally give a signal, it will almost as often give losing signals. So your losers will erase your wins, and it'll distract you. You'll be looking at something that's not going to help you make money. And the time you're looking at it, you'll be looking away from things that are there to help you make money. Question, I just became profitable this year. I only trade in the morning for 2 to 3 hours, but I'm making $100 to $300 a day on one contract with only 1 to 2 down days per month. How would you look at this performance looking back, looking for constructive feedback? Yeah, I think anyone who's consistently profitable is doing well. And I don't, if you're making 100 to 300, that means you're probably averaging about 4 points a day. And I think if a trader can consistently make 4 points a day, like 70% of the days with no huge losses, I think he's a successful trader. And the goals at that point are to increase the number of points per day and increase the number of contracts per day. But I think in my mind, a beginner should be trying to make 4 points a day. And if you can consistently make 4 points a day, you are a good trader. You're definitely a solid trader. So that's a good thing. So it sounds like you're right where you need to be, and then you just have to work on trying to increase volume. You do not have to increase your volume very much to do very well. So if you're making $100 to $300 a day, let's say you average $200 a day, if you just can get it up to 5 contracts over the next year, that's a couple $100,000 a year, and that's in pretty good shape. And if you can increase it to 10 contracts a couple of years from now, you'll be in that 1% of the population, earning $400,000 to $500,000 a year. Okay, question, can you explain what is your thought process to determine the probability of a trade before placing any order? Well, immediately, whenever I think about any trade, the first thing I think of is stop. Where's my stop? And if it makes sense to have a very tight stop, I immediately know my probability is not very good. If it makes sense to have a wide stop, I know that my probability is very high. For example, if you buy the 4 low, your stop is down here, and you say, well, that's a big stop. Well, that automatically tells you that the probability of making a profit is high. So that's where I start. And then beyond that, in terms of determining probabilities, I look at the market. What's it doing? Is it a bull trend, a bear trend, or a trading range? If it's a bull trend or a bear trend, is it strong or weak? Are the signal bars strong? Is it a second entry, buy or sell? Are we getting 2, 3, 4 trend bars in a row, up or down? For example, in a bull trend, are you getting 3 or 4 consecutive bull bars? Are the bodies big? Are the bars closing very close to their highs? All of those things increase the probabilities for bulls looking to buy. And you can easily get 70% probability of going at least a little bit higher. Question, I know you trade the chart in front of you and don't worry about other time frames, but when you trade tick charts, did it concern you that no two tick charts are the same, even if you have the same data provider and the same settings for the number of ticks? Yeah, that's one of the several reasons why I don't trade tick charts. The single biggest reason why I don't trade tick charts is because of I like rhythm. You know, I think we all have built-in biological clocks, and I like being able to predict things based on time. If you have a tick chart, you're not trading time. There's a time axis, but it's really not meaningful at all, because the bar closes based upon the number of ticks, not based upon time. Let's say you're doing a tick chart with 5,000 contracts. Well, one bar will have 5,007 contracts, another bar will have 5,800 contracts, because that last trade that goes from 490 or 499 or 480 up to above 4,990, right? That final tick that pushes it over 5,000 can be a small trade, it can be a big trade. So if the market just has 4,999 ticks and it just needs, I'm thinking of tick volume. If you're talking about tick volume, you just need one more trade, and it could be a big volume trade. So I'm mixing up tick charts and volume charts. Let me just go back to tick charts. For tick charts, you're right. All the vendors are using sample data, because if you use every tick, you'll have so much data your computer will move too slowly. So you're right. Everybody's chart is different. If you have the same chart on 2 different computers from using the same broker, your charts will not look exactly the same, especially if you use a low tick number, like 1,000 ticks per trade. So, but my main concern is early in the morning. Let's say you have 5,000 ticks per trade. Early in the morning, that could be every 1 minute, and then at 10 o'clock, it could be every 15 minutes. And I like knowing. I pay a lot of attention to the close of a bar and what the bar looks like when it closes. And with tick charts, it's just, I personally feel too much stress getting near the end of the bar, making decisions. Sometimes I think I'm near the end of the bar and it takes 5 minutes with me just sitting there with my finger on the button waiting to place a trade. Other times I think I have 2 or 3 minutes and the bar closes within the next 5 seconds. So that lack of the ability to time it, to anticipate, for me is just too unpleasant. So I don't use tick charts. And the same thing, originally I was confusing tick charts with volume charts. The other way is to have volume charts, like 5,000 contracts per bar. If you have 4,999 contracts, the bar has not yet closed, and the next trade might have 1,000 contracts on it, and all of a sudden the bar has close to 6,000 contracts, and another bar has 5,000 contracts. So the bars do not all mean the same thing. You can also trade other kinds of charts. A lot of people like Renko charts, where the bar closes after it goes up a certain number of points, like 2 points, and then the bar closes. If it drops 2 points, you get another bar closing. But again, it's not based on time, and that for me creates unpleasant stress, and therefore I don't use it. I make a lot of my trades based upon the appearance of the bar when the bar closes, and I want to be able to anticipate when the bar is going to close. And you cannot anticipate well enough. I cannot anticipate well enough using anything other than a time chart, where I can watch the seconds tick down and I know exactly when the bar is going to close. We take a look at OxyPete on the monthly chart. Okay, Occidental Petroleum. Look to the left. You got a very strong rally, but look to the left and you say, strong rally, and I'm still in a trading range. This could be a second leg trap, leg one, pullback, leg two. And then you say, high two, bull flag, but top of a trading range. To me, this could be a buy vacuum test of resistance, and then the bears could win, creating a double top. So this is the daily chart right here. Weekly chart, look to the left, look where we are. What has the market done at this price for the past 3 years? It's sold off repeatedly. And this rally is strong, so is this one, right? So is this one, and so is this one, but they all failed. When the rally is strong like this, it usually has to go sideways for at least a few bars and create a decent micro double top before it sells off. But this is not the way you want the bar to look if you're a bull hoping for a breakout above the range. Monthly chart, you got bear channel, bull flag, bull breakout, pullback, and then a breakout above the pullback. Head and shoulders bottom, left shoulder, head, right shoulder, but you're still right at the top of a trading range. This is one of those charts where you look at it and you say, oh, the momentum up is pretty good for the bulls here and then here. So momentum, which means probability, favors the bulls, but location favors the bears. We kept failing up here. The bears selling, risking very little, looking for a move back down to the bottom of the range. For me, I would, the top of a trading range is where I take profits on longs, not where I buy. So I would go flat, and then if it breaks strongly to the upside, buy after I see the strong breakout. For me, this is the top of a trading range. Plus, you're in the middle of a 10-year trading range, triangle, lower highs, higher lows, and then a double top bear flag. Kind of looks a lot like the daily chart of the E-mini. Daily chart of the E-mini, strong trend, and then lower highs, higher lows, and a possible double top bear flag. All right, so right now, strong sell-off, a rally, 3 pushes up, 1, 2, 3, 4. So it's a wedge bear flag, it's a double top bear flag, and you got to be open for anything tomorrow. We closed a little bit below the open, and therefore today has a bear body. But more importantly, it's a doji bar, so it's not a very strong sell setup for the bears. It's a double top bear flag or double top lower high. But with a doji bar and 2 big bull bars, more likely buyers below. But if we do this and get 3 or 4 bear bars, then the probability favors at least a little bit more down. It's just so easy when the market's in a trading range to just look at today. You look at today and say we're going higher. You look at today, we're going lower. You look at today, we're going lower. And then look at today on Friday, we're going higher. You can look at the whole chart and look to the left, and if you see a strong leg up or down, but you're still in the trading range, it's more likely that you're going to reverse than break out. The bulls, right now, I do think we're going to get up here, right? I think these were tests of this, and we're reversed up pretty well there and here, 3 decent bull bars, and we've got an important magnet up here. So I think we're going to go up there. However, right now, I would say 55% chance the correction has ended and that we're going up here. If we break strongly above this, then 60%. On the other hand, if we reverse down from this double top or from a double top here, then 50% chance we'll get down here. Okay, hope everybody has a good night.